The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Tech. My name's Gaurav Sodhi. Joining me today is analyst Mickey Mordek. Hey, Mickey.
Hi, Gaurav.
With us also is analyst James Carlisle. Hey, JC. How you going?
Good, thanks. How's it going?
Feels like it's been a while since we've all sat around with our microphones and laptops together.
Well, I've been ready and waiting.
Yeah, I had to
haven't had the call. Haven't had the nod.
Well, I had a wedding first, and then we just got busy doing work, I suppose, which is no bad thing. So in between that, it's been, 3, maybe longer weeks. It's been too long for the three people that listen to the podcast. One of them being my mother, probably. Right, how are we all?
Gaurav's mum.
Oh, yes, hi, Mum. Yes, she's gonna mention that. Shout out, Mickey. You've got a great story to tell, actually, because the stock that I wanted to talk to you about, Omni Bridgeway, I think you've actually this may be the third time, certainly at least the second, and maybe the third. I've heard you talk about this business for a long time. We've never shown as a team much interest because there was a time where Mickey sent out this mammoth, legendary spreadsheet, which just confused the heck out of everyone. And ever since then, we've just not wanted to touch this thing. But it's come all the way back. You spent a lot of time, putting a lot of work to convince us about it, and I think it's actually a strong idea. I think it's worthwhile going through what makes this an interesting business, because when one first looks at it, it actually doesn't appear that way. So talk to us about first how you came across the idea and what makes Omni a decent candidate for an upgrade.
Well, I think I first came across it just by reading about it. Like just generally kind of in the media, and it was kind of one of those ones where I'd kind of always been interested in it, but hadn't had a chance to get around to it. So I'd spoken with Nathan and a few other people, and decided to take a look at it back in, I think it was February or March, for the first time. So for those that don't know, Omni Bridgeway is a litigation funder. Originally, it's had a long history. It used to be known as IMF Bentham, but it recently changed its name after an acquisition. So basically, what these guys have done for 30 odd years is they go and find cases. Cases where they can basically come in and fund like a lawsuit on behalf of claimants. So oftentimes those claimants are, wronged groups of people, but sometimes they can be corporates or something like that. So basically the goal is to, where the claimants don't want to take on the risk, or it's too time consuming, or it's too risky to actually fund those cases themselves, then Omni Bridgeway can actually stand in and provide the funding and get the wheels in motion to actually kind of pursue those damages, whatever they may be. So they've got a long track record of doing it. So I think the first thing that kind of appealed to me when I looked at this business was just looking at the share price chart. And I know we're not kind of chartists or anything like that, but when you see a business that's gone from 20 odd cents to $4 odd over the space of 20 years, that I think that's probably telling you something. So if you go back and you look at the returns that they've generated over that time, they're quite phenomenal. So it tells you that they're doing something right, and they've done it pretty consistently. So found that interesting. And then I think, and also just in terms of the returns, once you start to go through this business and you realize the returns that they're actually generating, not just for shareholders, but also on these cases as well, they're quite phenomenal. And I mean, I dare to say I haven't seen kind of returns like this anywhere. So kind of those two things were the main thing that gets you interested. And so that was kind of what made it, I think, an interesting business to begin with.
So just to clarify, so when companies want to pursue lawsuits, or when individuals want to pursue class actions, they need to be pre-funded because legal work is very expensive. So these guys provide some of the funding, and in return, they take a slice of the winnings if those cases end up being successful. Is that correct?
Yep, exactly. Or it can sometimes be a multiple of the costs involved. So,
Okay. Oh,
but
I see. Yep.
yeah. But it depends on how it's structured. But usually it's a percentage of the winning. And so generally the way that they look at these cases is they're very selective, and so they're only looking for a very particular type of case. So these are cases where, for example, the claimant is going to act rationally. So a lot of cases you can see that the people that have been wronged, maybe they're not even interested in the financial aspect, so they're just going to try to go after something that isn't reasonable. So they look at who they're actually partnering with, and then they also look for cases where they think the upside is roughly 10 to 1 in terms of what they're outlaying, and what they're potentially on the hook for if they lose, compared to the potential damages that they think they can get. And that basically allows for a big enough buffer where the claimants are getting at least 50% of any outcome, and then Omni Bridgeway will receive the rest of the profits.
And so, what sort of percentage of that 10 times? I mean, they spend $1 million on a case and they win. Let's say they win 10 million. What sort of percentage? I mean, they're getting their million back to start with, and then what are
Yeah,
they?
I think
What are they looking for?
it tends to be kind of like 20 to 30%, but it obviously varies because it's
So the case is a 10 bagger, but they're hoping to double their money or triple their money, sort of thing.
Yeah, that's right. So like the typical kind of return on investment, on invested capital here has been about 132%. So if you put out $1 million and you get 1.3 million back, and generally that takes about, on average, this is just going back historically,
But that includes the losses. That
that
includes
includes the
cases
losses.
they
That's
lose.
right.
Yeah.
Yeah,
So
yeah.
on the ones they win, they're hoping to make maybe 2 or 3 times. Yeah, right.
Yeah, 2 or 3 times, and then occasionally you'll lose one. I mean, they have a really high success rate. It's above 80. It's somewhere between 85 and 90%. And so success isn't always a slam dunk. You know. 10 times your money type thing. It can also be a settlement where that's also a reasonable outcome. So but I think that you get these, you can get kind of these bonanza payoffs in some really meritorious cases, that uh, provide exceptional returns.
Meritorious. Wow, you've been reading a lot of legal stuff, haven't you?
Yeah, that's what you've been talking to the lawyers. That's right.
Yeah, you can tell. Wow. When I first heard about this business, JC, I'm not sure what your thoughts were, but I was not. I found myself. I had a lot of problems with the business model at first, because for my all I thought that all it was really was what do you need to succeed in this business? You need a pile of cheap cash, so you need a cheap source of capital, and you need some lawyers to tell you which cases to take and which cases not to take, and your revenue recognition, because you pay your costs upfront, the legal costs upfront, and the payoff is in the future and uncertain. So your revenue recognition, there's so much discretion in the reported numbers. I didn't quite believe the numbers, and that was my first problems with it. But can we go through some of those issues? JC, what was your? Did you? I can't remember if you like this
Well, look,
straight away.
I mean, I've been aware of this stock for some time, but my problem with it has always been just that it's too complicated. I've never really
Yeah.
understood what its competitive advantages are.
Well,
And
maybe
I
that's
think
a. Sorry, go ahead.
no, I was just going to say, I think, and that was the concern when
Yeah,
Mickey brought
that
it this
was.
year as
Yeah.
well, because if someone's making such good returns, you'd
Yeah.
think, I mean, all it needs is a bit of capital,
And
and
some
as you
lawyers.
say, some
Yeah.
people to decide which cases to take on.
Mm.
And they've done very well with that, of
Mm.
course, over the years. But that shouldn't be rocket science, and so you'd expect those returns to be competed down. But
JC, it's
Mickey's
around here. It's known
worn
as
us
rocket
down, I suppose.
surgery. Remember?
Yeah, rocket surgery. Yeah. But yeah, I mean, look, I think they have sort of pole position. They have relationships with lawyers, don't they? These are the arguments you've been making, Mickey, isn't it? Aren't they? And they've got, they've got a lot of experience in this. They've got relationships in the industry. They've got critical mass barriers. So there are barriers to entry. You've got to set all this up. They've got the funds that provide them the capital. So they are in a strong position. relative to newcomers.
You make a good point, though, Mickey. With returns this high and the startup costs relatively simple, why haven't more competitors come in, and how have they managed to sustain these returns?
Well, I think so. It's still a pretty nascent industry. I mean, it's
Meritorious, nascent. Wow, you've been hitting the legal books.
Geez, I'm just trying to sound smart. I've got to hope it's going well. No, it's I mean, so I guess it's still like the competition. I think is definitely going to be coming. These guys were pretty much the pioneer in the space. So they started out, 30 years ago as a little kind of WA based outfit.
The
and
pioneer in Australia, though. I mean, they've been people doing this in the US and the UK and Europe. I'm
I think
presuming
these
for a
guys
long
were
time.
pretty much one of the first anywhere, basically.
Really.
Yeah,
Okay.
yeah. So, but I mean, there's kind of been, there are some other competitors, and we've just kind of written an article so members can kind of see how they compare. But Omni's got by far the most offices and the widest geographical kind of spread now. In terms of winning these cases, actually sourcing these cases as well. I think they've just got an established network of relationships with, say, law firms and with places to basically source these cases, and they've got offices and the know-how, and so I think that helps as well. But yeah, so I think competition's coming, but I guess basically it's kind of like any fund manager, realistically, and I think this was the leap that we kind of made with it, was that yes, there's going to be other people coming in. However, it's like if you're a good fund manager and you're good at your job and you provide good returns, then it doesn't really matter how many competitors you have. You're just better. And I think these guys have been doing it for long enough. They've got the expertise, the track record, and kind of the global infrastructure in place, that they're just way down the road. They've been doing it for way longer than lots of other people. And so I think that just sets them up well. I think ultimately the competition is going to be coming for them, but it will take years to kind of replicate, the network, the kind of offices and the infrastructure that they have in place. So I think they can still keep going. And even if returns do come down a bit, you're starting at 30-40% per annum. So, I mean, they can come down to 20%, they could come down to 15%, and that would still be highly attractive. So
It's interesting that the market, I mean, they've got a long record of pretty outstanding numerical returns. It's interesting the market has never really valued them all that highly. I want to get your thoughts, Mickey, just quickly on some boring accounting stuff. Just in terms of revenue recognition, profit recognition. These cases come in with I guess, a expected return or a probability of success. Does the business count the probability weighted returns, or does it wait for the cash to drop in and then recognize returns?
yeah, so one of the things about Omni Bridgeway, which is sort of deceiving, so it's actually a more profitable business than it appears, because, as you say, so when you take on a case, you've got this kind of expected outcome, and there's two ways that you can account for that. On the one hand, you can say, we think the case is worth this much, and then over time, as the case progresses, you can take fair value adjustments, and so you're kind of saying, our profit on this case we're assuming is this, and that's kind of the aggressive way to do it, because you're kind of making an assumption that's very open to management discretion
Absolutely,
as to what profits you're
it's a
booking.
made up number, really, isn't it?
But
It
you
is.
can't, but you can't sort of fool people forever. The fact they've been
Correct.
doing it for 20,
Yeah,
30
yeah.
years is
Yeah, but
all their
that's
management
not
edges over the years, I
that's
suppose.
not how like Omni Bridgeway does it though. So Burford, one of their US competitors, did it this way, and they got into a lot of trouble for doing exactly that. So
What a shock.
they were booking a lot of these profits up front. It turned out, the cases, they were probably a bit aggressive with the accounting, and so the share price fell quite a long way. Omni Bridgeway takes a much more conservative approach, so it only basically capitalizes its cost base on the case, and so then it only books the profit once the final outcome and the payments and everything have been settled. So
Oh, wow.
so
So,
they've got all these assets on the balance sheet that are probably worth much more than what they're carried at, basically.
Okay, but some of those assets are actually costs that have to be counted at some point, I'm guessing.
Yes, well, so
What if they lose?
the costs
Yeah.
have already been incurred. So they incur the costs
Mm.
in terms of pursuing the case.
Oh
Right.
no, but you
and
said
then
they
they just
capitalize them.
yes,
So
that's
so
yeah.
so, so they
Yeah.
go on the balance sheet. They don't incur the cost
Oh, sorry.
until
Yeah.
until they win or lose the case, and then if they
Mhm.
lose it, then that's going to
That's a
go through
write-off.
as a loss.
Yeah.
Yeah,
Yeah. Yeah.
yeah.
Yeah. But I think so in terms of like the profits though, you know that they're not kind of booking the profits in advance. They're kind of taking the profits hopefully at the very end. So I think that's a much more conservative accounting
Yeah, so you got a
treatment.
whole load of projects, like it's almost like a property developer. You got a
Yes,
whole
that's
load of
right.
projects booked on the books at cost, but you could make a lot more for them, in due course.
Yeah, you might laugh at this, Mickey, but when I was looking at this, I thought of this in terms of a mining services business because it's got a big kind of work in progress balance,
Mm.
and it capitalizes all the expenses into that balance and recognizes profits much further down the line. The accounting treatment is quite similar.
Yeah. So, but I think the way that to think about this business is, it's very tricky with the accounting. But I think now that it's pivoting to a funds management model,
Yeah, can we
the
talk a bit?
accounting.
Can we just quickly talk about that? Because I think that's one of the key planks, actually, of the investment case. So in
That's
the
one of the
past,
worries to me, is
one of
because
the worries.
because it demonstrates how the capital's flowing in, doesn't it, into the industry. But perhaps
Oh,
Mickey, you
okay.
better
Yeah, no.
explain what's
Yeah,
happening
can we
here.
just explain? Let's dwell on that for a second. So, Mickey, in the past, the business has internally funded its cases, and now
Mm.
it's accepting external capital to fund its cases. Just talk to us about the change and what that means for the business.
So previously they would just fund these cases from their own balance sheet, and that was very profitable because they were very good at it and they knew how to um, get good returns out of that. But it's kind of like if you're a good investor and you're just using your own money, there's a limit to how fast you can kind of grow because you're constrained by your own capital,
Mm.
and so they have basically chief executive Andrew Saker came in 2015. Originally, he was a consultant to the business, and he had a plan basically to pivot into a funds management model. And basically, that would allow them to charge management fees, performance fees, and effectively become kind of like a less. They would have to put less capital up themselves, and so they could grow quicker and have a kind of more steady, recurring revenue base rather than these big kind of lumpy one-off case wins here and there. And so that transition is underway, and I think they've still got a few legacy cases on the balance sheet, but not too many now. And I think over time, so that they will run off soon, and then once that happens and the management fees start to build up, it should become a bit easier to see the profitability of this business over time.
Mm. And do you, in terms of you looking at it, do you look at mostly the cash flow here? Is that what's most important, or do you try and make sense of that complex P&L?
No, well, so I think the way you've got to look at its earnings power is you don't want to look at the kind of cash flow in any one year. So
Mm.
they've got so when they take these investments, so when they're putting money into a case, that's it's highly unusual because they're kind of that's an investing cash flow. So that looks it's not nothing not much runs through the cash flow from operations. So whereas like a normal fund manager, you'd mostly see everything in operating cash flow. So this is kind of more everything's in the investing cash flow statement. So that makes it a bit trickier. Um, but I think the way you just kind of simplify this is you go, how much fun are they going to have? And then you can say, well, what's the management fee on that? What's the performance fee? And then you can make some estimates about the returns, and then you can say, well, we think the average case, our fund will have a life of say 5 years or 6 years, and then you can sort of annualize that figure, which you've kind of done in that article. I don't know if I've
Mm.
explained that all that well, but I think
Okay,
it's
no, I
probably
think I get it. And JC, you had some concerns about the change in model. Can you elaborate on those?
Oh, well, just I think the model makes sense. If you've got more cases than you've got money for, then why wouldn't you get money from other people and take a little fee for it? My concern is just that it demonstrates how money is flowing into this. People are attracted by it being an alternative asset, as it were. It's a different, its returns are not correlated with the stock market, so it's a way of getting capital to do something a bit different. And do you have any numbers for how much money's flowing into the industry? Is there is it growing at 10% a year or something? Do we know about that?
Yeah, well, so I guess the way that I think you think about in terms of the growth of the market is that this is a relatively underpenetrated market. If Omni Bridgeway is one of the first to be doing this, or it's quite small. It's still only got a couple of billion in funds under management, and we're talking about the entire world. So and there's a few.
So it is growing quickly, but what you're saying is there's a long way for it to grow. There's a lot of the funded court cases are still a very small part of the total. Externally funded court cases.
I don't think that there's going to be like a certain addressable market number that you can throw out there, but I think we're kind of at the early stages.
And I suppose the market that we're talking about is the market for people who want to outsource the funding of their court case, and so that what that means is very open to debate. It's just I worry that the more money flows into it, then that's more money chasing the same number of cases, but perhaps what you're saying is the number of cases that want this sort of funding is going to increase.
That's right. I mean, it's not just class actions. Like one of the big market opportunities looking forward is potentially in the corporate space. So a lot of corporates, for example, if someone infringes on your intellectual property or breaches a contract, you might want to pursue that legal action. But if you're a CFO and you pursue that case and you lose it, you've got that risk on your balance sheet. So lots of CFOs find it attractive to be able to outsource that function, and if it pays off, then they're not taking any risk, so they can tell their shareholders, "Hey, look, we won some money." And if it doesn't pay off, well, then they haven't taken the risk. So there's very little downside. So for corporates that are kind of looking to pursue legal action as well, that's a potentially massive market, and it's one that Omni's looking into. There's enforcement as well of cases when people have kind of hidden assets, and that was a big part of buying Omni Bridgeway as well, was gives them some more expertise in terms of actually enforcing some of these wins as well. So especially for international kind of complicated situations where people don't want to pay you. So
Well, look, Mickey, you've done a good job of actually making this complicated situation quite understandable. We've had a few goes at it. We've made life a bit hard for you internally, but I think it's an interesting idea. You own, it's currently a buy idea at the moment. I think the stock's gone up a little bit, but still on the buy list?
yeah, it's still on the buy list, under $4.50 at the moment.
Okay, and you've got a couple of, I think, detailed articles about it. Each time Mickey brought it to the Dragon's Den, I think there was an article. So there might be a little bit of research on the website as well. JC, anything else to add on Omni before we move on?
No, I think it's a nice idea. Well done.
Yeah, okay. Let's carry on. Let's move on to idea I struggle to describe as nice, but Telstra, which has been a bit of a
bit of a dog is
yeah,
what Telstra's been.
yeah. Sometimes we often have these projections of what a great business looks like, and then I think it's useful also to have projections of what a poor business looks like. And for a long time, Telstra was in that latter camp, but changes might be afoot. So I might just begin there. We've been very critical of Telstra, it must be said, for a long period of time. Certainly ever since I've been covering it, and I think even before then. And the problems with Telstra are not entirely of its own making, although a lot of them actually are. And the problems begin with the NBN. Now, the NBN, of course, is a monopoly fiber network that's designed to replace Telstra's own monopoly copper network. So once the government built the NBN, it paid Telstra a huge amount of money, about $11 billion in compensation for taking away the monopoly. And it also took away a lot of the revenues that came with the old copper network. So Telstra used to charge other ISPs, internet service providers, and other customers using their wholesale copper network, and that brought in about $3 billion of operating profit every year. A raucous amount of money, just a crazy margin, huge business within Telstra. And all of a sudden, that money's been ripped out of Telstra. So that it's about $3.5 billion a year that the business is no longer making. And that explains why a 10-year comparison of Telstra's profits looks very unflattering, even though we live in a completely different world than we lived in 10 years ago. It's largely because of the wholesale profits missing from Telstra. Now, Telstra, of course, has been aware that there's going to be a big hole in their earnings. And for 10 years, they've been trying to plug that hole with stupid acquisitions, with dumb decisions, with desperation, really. They've been throwing capital at businesses, trying to do anything they can to plug that hole. And I think finally, that flailing desperation is at an end, because Telstra announced that instead of going out and trying to wildly fill an earnings hole, they're now admitting that they are going to have to adapt to the world. And they're talking now about splitting the business into 3 different segments. Now, this is not entirely new. They have hinted at a split before, when we've kind of inferred from that there will be a more formalized split of Telstra to come. It's too early to confirm whether that's true or not, but that's looking increasingly likely. So the 3 new businesses within Telstra are going to be Infraco Fixed, Infraco Towers, and a services business, which they called ServCo. Now, you guys with me so far? This is a little complicated.
Yeah, so Infraco Fixed is the fiber. Infraco Towers are the mobile towers that are connected to that fiber.
Yep.
Yeah, and the Infraco Fixed connects to what, the NBN's
You're almost there, James. That's
last
yeah.
mile connections. Yeah, and
A
then
bit more. It's a little bit more than that. So in Infraco Fixed, you're right. A big part of that is the towers, but a larger part of that is the ducts and exchanges.
No, hold on. You said the towers surely are Infraco.
Oh, sorry, not the
towers,
duct.
yeah. So the
the
fixed is their
exchanges
fiber.
and the ducts. Yeah. So the fixed includes ducts, exchanges, fiber, and pieces of fixed infrastructure that aren't really going to be growing, but that would generate a rental return, an infrastructure style rental yield.
Why does the NBN not own all the ducts and fiber, the ducts and exchanges and stuff? Or am I missing
they'll
something?
have to replicate it if they built it. It's better just to use the stuff.
Oh, so they rent them off Telstra.
They rent them off Telstra.
So why didn't the government get Telstra to give them that as part of the 11 billion?
It's
Make
a good
it
question,
12 billion
James.
and give them all the exchanges.
It'd be better if you were in charge of the split.
It seems strange, but anyway, look, it's a bit of a mess. I mean, and it is in every country in the world. So.
How hard is it going to be to split up everything?
Well, they've done that already internally. I think they've done a good job of doing that. It's not that difficult. The difficult part is because at the moment, obviously the Telstra business doesn't pay to use its own infrastructure. They have to come up with service agreements, effectively infrastructure rental agreements for every piece of infrastructure that the mobile business uses or the internet business uses. And that's going to be the hard part. And that's going to determine how much value is actually in the different pieces of the pies. Now, we'll come to that in a second, but let's quickly talk about, so I think we've got that fixed portion down. The biggest customer of infrastructure of the Infraco Fixed business is the NBN. It'll be Telstra itself, and it might be some third parties too. It will generate very stable, high margin cash flow, but it's likely not to be growing anything greater than CPI, and I would guess maybe even less than CPI, depending what CPI is. So you've got that business. Then you've got Infraco Towers, which is one I'm really excited about. We wrote an article about a year ago suggesting that there was a wonderful towers business inside Telstra. I reckon someone at Telstra read that and decided, yep, let's do it, boys. Let's do it.
They should be hiring you for strategy, Gaurav.
Well,
and that owns the hardware that they put on buildings, but it doesn't own any actual buildings. I mean, it owns, so those things that you see around, the mobile tower stuff, they own all that, but they have to rent the locations. Is it that the locations are important and that they've got agreements with the right people to have the right locations, or could they be shunted out of those positions and
Yeah. So
have to take it all down?
when you're building a mobile network, what you have a choice. There's a whole different array of infrastructure you can use. You can use people's buildings, in which case the building owner gets a rental yield for it. In lots of places, you actually have to erect your own infrastructure, which means a big pole with fiber backhaul connected to the pole. And
you just have to get the council to agree to that, do you?
you need to
Basically.
get the council, but the most vital part is it has to be connected to fiber. So those
Okay, yeah,
towers are valuable because they've been scouted for locations. They're not just randomly appearing. They're there because that location is a good location for microwave transmission, and it's also there because it's connected to a fiber
so
backhaul.
Telstra's connected it up, and so it has a
Yep.
value for that reason.
Now, you might think that when you use your mobile phone, that it's just radio waves going through the air. That's partly true, but data travels not through, well, it does a little bit through radio waves, but largely, even more so, it travels through fiber. The mobile networks of the mobile operators are connected with dense networks of fiber. We don't. I wasn't aware that people weren't aware of this. But I was speaking to a banker actually about this, and he didn't know. So I'm guessing a lot of people do not know that mobile networks utilize dense fiber.
If you make a mobile phone call in, say, Sydney, then those radio waves will travel a mile at most, won't they? I mean, or two. That's the sort of thing, and then they'll be onto the fiber. Yeah.
And they're not dense enough. They're dense enough to carry voice, but if you're watching a film or YouTube on your mobile phone, radio waves aren't dense enough to carry everyone's YouTube watching. So the fiber helps move the data around and make it a very fast network.
So Gaurav, what would someone? So I guess the point is that it's just so hard to replicate.
Exactly.
Things.
It's really hard to replicate,
yeah.
and every tower can host multiple networks. So on a single tower location, you can have a Telstra equipment, and you can have Vodafone and TP and Optus equipment.
But Vodafone would then have to rent the fiber that connects that tower, wouldn't they?
Yeah.
As well, they don't have fiber to Telstra's towers,
Yeah.
so they then have to. So they have to have a deal with Infraco fixed as well, do they?
Potentially, or someone else might own the fibers. So before TPG and Vodafone merged, TPG actually owned all of Vodafone's fiber backhaul, and so Vodafone was paying TPG fiber rental for using their mobile for their mobile application. So
it makes a strong case for a nationalised telecoms industry, doesn't it? Just have the
Yeah.
government own the whole thing.
Well, this is what they're
very
talking about in
complicated.
New Zealand, potentially, where Infratel, which owns 50% of Vodafone New Zealand, is talking about building a single wholesale 5G network and then leasing it out to the competition. I think that makes a lot of sense. But
For
it's
the
a controversial
hardware,
point.
it seems. Yeah, but
Yeah.
anyway, that's what we got. Is
Anyway,
what we
yeah.
got.
So
yeah.
internationally, this is not new. America has all over North America, in fact, they've actually privatized tower networks, stripped them away from networks and have them as individual assets. In many cases, the tower networks are worth more than the mobile networks. And that's because when they're inside Telstra, for example, when the tower business is inside Telstra, it is the same cost and hosts only Telstra gear. When it's made independent, it can host 3 networks without changing any of the cost structure. So the earnings can be quite explosive. They're absolutely vital pieces of infrastructure. There's very little capex. So the cash yields and dividends are extremely high.
So that's interesting. So Telstra at the moment is only putting its own traffic on those networks.
Yes.
So then its earnings could go much higher if it was able to take on other networks onto those.
This is what we're
assets.
unsure about. That. So the company hasn't elaborated on this. The value of the tower business will depend on the contracts written. If Telstra, if the towers business is allowed to host other networks, it would be a fantastic business. If it's only allowed to host Telstra, then you're really dependent on Telstra pricing. I think that would be a mistake. I don't see the point of actually splitting the businesses unless you're wanting to open it up and allow other hosts.
But I suppose if you've got three players and each of them have got 1,000 towers or whatever it is, then you've got 3,000 towers. It makes far more sense for all those 3,000 towers to be on the same network. Instead of having 3 networks of 1,000 towers, you could have 3 networks of 3,000 towers, and with the same amount of traffic going through each.
They're also third party. So actually, the largest tower business, even larger than Telstra's, is actually owned by a private enterprise, majority owned by Macquarie. They own the largest network tower, and they've been playing this game for a while. If they ever, they probably haven't IPO'd it because the business is just too good. I think it's called Axicom or something. So they might actually just buy up Telstra's tower business. I think that would be, if they're allowed to, if the competition regulator allows them to, that would be a possibility as well. But anyway, there are lots of different ways to monetize that towers business. Andy Penn has explicitly said that they will look to generate a return from it. I've inferred that to mean that business is the first one that will be formally split and IPO'd or sold, and I think that makes a fair bit of sense. And then you've got the services business, which is the Telstra that we are familiar with generally, which is the Telstra that provides mobile services, NBN services, and whatever the other services that Telstra provides. So those are going to be the three parts of Telstra. The big benefit from Telstra's point of view is that the split has coincided with a very large cost-cutting exercise, and we've kind of written about this in the past. They had something like 900 plans that's come down to 20. A whole load of costs have been stripped from the business, and this is all long overdue. Telstra has been a mess for a long time, and this simplifies the entire business that's coincided with this restructure.
So the point is that when you've got these businesses sort of standing on their own 2 feet, you can't sort of fudge anything. You've got to really, it's all going to be, the cost structures are going to be there for everyone to see, so they've got to sort of rationalize it. Whereas in the past, Telstra's accounts, I remember when I covered the stock briefly, I mean, they're such a mess, aren't they?
Yes,
And they
yeah.
change year to year, everything changes. And so when you simplify it all down, you're sort of left with nowhere to hide, I suppose, on the cost side.
Yeah. And one of the worst things about Telstra is the dividend policy, which I've said for years is just madness. They spend too much on dividends. It impacts the competitiveness of the business. And they are afraid of their shareholder base, and they'll go to almost any lengths to maintain the dividend. That was clear from the AGM this year.
But they've also got people saying they should buy back shares. I mean, they have bought back shares, and the people saying they need to have a certain amount of debt and all that sort of thing. So, I mean, it's all about fine tuning the debt levels, I suppose, isn't it? But it's a distraction, isn't it, from the amount of money they need to spend on their business.
It is.
But based on everything you've said, though, it just seems like it's it's obviously got some incredible assets in there, and it's obviously a pretty high quality business. So probably, don't know. I mean, yeah,
Depends what the regulator wants to allow them to earn there, doesn't it? Ultimately, that's the problem with all their businesses. The services business, is that regulated?
No, that's not regulated. The infrastructure business,
Both infrastructure businesses,
will have
presumably.
some regulation, but it's also the contracts. It would have to strike contracts with all its, particularly with Telstra, but with other parties as well, if they're allowed to host other parties. So that will determine how much value is created. Just to get back to that point about dividends, though, the split will allow the Telstra to actually relinquish its dividend obligations into the infrastructure arm of Telstra. So the infrastructure business will handle the dividends. They'll just receive cash and pay out cash, and all the shareholders who are whinging about dividends will go into that vehicle, and that will free up the services business to actually be much more aggressive and redeploy capital to grow the business, which is what they desperately need to do. To me, that business still is not as aggressive as TPG, which is the clear, in my view, the clear threat to Telstra. So the split is a really good move for Telstra, and it has a good chance of creating a lot of value, which is why Telstra sat on our buy list for a while, and why some of the funds own it.
of the three, which ones do you like the best?
The towers. I'm least interested in the services business. That's the part of Telstra I don't like as much. But the infrastructure assets are quite attractive, especially in a zero interest rate world. And the towers business is not. It's not an industry that Australian investors are all that familiar with, and I think there's a decent chance of mispricing that or not appreciating how much value can be created out of towers.
And the towers are still valuable with 5G. I mean, you just put 5G. I mean, because 5G, you need more towers, don't you?
Well, that's right.
There's
going to be embedded growth in that towers business because the number of cell locations you need in 5G is an order of magnitude different to your 4G counterpart. So there's a lot more growth coming from that towers business if it's allowed to be free. So I think that's the most interesting part of the business, and the fixed business I think will be a great dividend yield business, and we'll have to see how the services business emerges out of all this. This is going to take a couple of years to all finalize. The timetable that they laid out at the AGM was, they're looking at doing something with the towers business next year, but it won't be for several years before they split the infrastructure and the services side. So I think Telstra still remains a buy. I think there's a lot of latent value that's finally getting a chance to be unlocked. There's lots of interesting assets there that have never really been monetized properly, and they're finally going to be illuminated. So it sits on the buy list for now. Any other questions, gents, about Telstra? Shall we kick on?
That's the answer to that.
Yeah. Geez, we've had two very complicated, big, heavy-hitting topics so far. So let's go to something much lighter, which is the real estate market, JC.
Well, the real estate classifieds, which they're funny businesses. So REA and Domain is what we're talking about, and they're funny businesses because you can, once you start looking at them, there's so many little rabbit holes you can go down the way they earn their revenue, and they can.
I thought we were trying not to make this one complicated.
Well, that's what I'm just setting the scene for simplifying everything. They earn revenue in fairly complicated ways. And then, there's listings and there's what's happening to those in the short term and all the ups and downs involved in that. But I think you can look at them by taking a step back from some of that and think about the value that they're adding and the long-term picture. And for me, that they encapsulate what you get when you when you improve a business. So in the old days, you'd put an ad for your house in the newspaper, and it would have you'd pay by the word or something, and it would, you probably wouldn't even have a picture. It would have a few lines, 2 bathrooms, blah blah, and that would be what you got for your real estate ad. But by moving it all online, you can have an endless amount of for each property. You can have pictures, you can have videos, you can have all of it. So it's a far better. So it's not just about a shift from print to digital. It's about the product actually on digital being better. And so there was a market. People thought, 15 years ago, people thought, so the market size for these property classifieds is the TAM. So then people think, well, and this has implications for things like Ordinate as well, because people, when they think about that, the shift, they think about it in the existing, in terms of the existing market, but by being a lot better when you become that digital business, you can expand that market. So estate agents, the classic point is that estate agents charge whatever it is, tens of thousands, depending on your house, a few percent, potentially for selling your house. And your real estate ad, I have no idea what it cost in the old days, but a few $100. And now it's, perhaps a few $1,000, but there's a few tens of $1,000s to play with here, and being so much better businesses now, they're able to have a stab at that, and that's why perhaps they've performed so well over the last 15 years, because people, perhaps including ourselves, didn't really anticipate.
And Australia was the leader, right? This is the first time in the world where we had such a dramatic shift. So there was no other real examples of what could happen.
Yeah, I think, no, that's right. I think it all happened fairly much the same sort of time period, because all those things started getting better, and all the money needed then to be spent in developing the products, and they're still doing that. They're still developing these so-called depth products, which are basically the sort of premium products, but everyone's on some kind of premium. You don't sell your house without a premium something. You don't get the basic ad for because you're talking about, you make an extra % on your house, and that's worth a lot of money. So so they're great businesses.
The other thing that's really good about them is that the agent is in charge of booking the ads, but the property owner is in charge of paying the ads. So the agent becomes a really powerful advocate for depth products and pay as much as you want,
Yeah, yeah.
because he doesn't pay anything. It's because the poor old property owner actually pays for all of everything. And in the context of selling, if you're in Sydney anyway, a very expensive house, um, the couple of thousand just seems like peanuts.
Yeah,
It's a
and the
great
interesting
place
thing
to be
also is
for
that
REA.
for a lot of for most markets in Australia, it'll make sense because of the pricing. It'll make sense because of that value, I suppose. It'll make sense to put ads on both. So the level of competition is perhaps less than it seems.
Yeah.
Although REA, I think, is the clear. It gets the higher number of page views, the higher number of visitors. It's
But they
stronger
both
in most
claim,
markets.
I've seen billboards where domain claims leadership as well. How can they both do that?
Well, I think you have to look carefully on the different. Domain has a leadership position in Sydney, I think,
Okay.
and is relatively strong in Melbourne. I think it's strong. It's strong in Canberra as well. Domain. So there are little pockets where it has leadership, and if you pick your metric, there might be some where it's a bit higher up, but overall the REA is pretty dominant.
So James, as well, like this seems well like possibly eventually may kind of evolve into a winner takes all kind of market, because I think just as someone looking at houses and things like that, then you just want to deal with one website, right? And kind of the same for the real estate agents. Is that kind of how you
Well,
see
that's
it,
not
or?
how it's working out around the world. In the US and in the UK, they've got two players. The estate agents certainly want there to be two players, because otherwise, they're um,
Mm.
they need there to be some competition. And I think as a user, I don't think you mind too much either as a potential buyer, as a viewer of properties, because you go on one site and you see something, and you go on another site and you might see something else. Um, yeah. Look, the way the markets in the world seem to be settling down is with two players. It would be crazy to have 10, but I think two makes reasonable sense for all parties.
And
Um,
so, JC, do you look at the numbers on these two platforms? REA, the metrics are amazing. Clearly one of the best businesses in Australia. Why does Domain look so lousy? Why does its numbers look so bad?
Oh, they look pretty good. It makes an EBITDA margin of 30 something percent. But REA makes much more than that.
Well, REA makes like
And
double
that's
that, doesn't it? Yeah.
because so Domain, I say it makes sense to put your ad on both sides. I think it makes sense to put your ad on both sides at a price. I think in most markets REA
Okay.
is essential. You can't really go without it. But and Domain, at a price you'll cover that base as well. But there's a price for it. You can't do without REA, and Domain is a nice to have. I suppose that's
Okay.
what
So they just have
makes the difference.
lower listing density, lower prices.
Yeah, yeah, low
Okay.
prices. Yeah. Um, so that's sort of the backdrop, and they're both I think fabulous businesses. Domain still has that little print business going with it as well, which is
Hmm.
sort of not quite such high quality. That's sort of phasing out, I suppose. But what's interesting, I suppose, is that they've had as tough a year as they've ever had, really, because it didn't just start with the pandemic. They they already in the first half of the 2020 financial year, they were suffering from very poor listings on account of the Royal Commission putting pressure on lending standards and all that. So listings were already down, and then the pandemic hits, and yet they suffer. I got the numbers somewhere. Hold on 1 second. and yet REA saw revenue in 2024 6% and profits EBITDA down 5%. Domain was a 9% fall in revenue and EBITDA down 17%, which just tells you in such a tough year shows what strong businesses they are,
Yeah.
and also shows the higher operational gearing of Domain, because its profits have fallen by so much, but or by a little bit more, but so despite all this, so the point I was going to make is that they're now, back at all-time highs. They were hitting all-time highs in January, February, and then they pretty much halved in March when property inspections were halted, as were open auctions, public auctions, and so they've halved and then got back to their previous price and then added another 50% this year is roughly what they've done. So it's been an extraordinary turnabout, and I think reflects people sort of coming to terms with what quality businesses they are, but most particularly it chimes with the market's desire for this sort of stock. So any stock which has that kind of quality, that kind of durability, and that kind of growth in cash flows long term in the low interest environment, these are exactly the stocks that the market's gone completely crazy about.
Can we just talk about that growth for a moment? Because this is something that this is one of the reasons why I don't own REA and I'm probably wrong about this, but I mean, I think it's clear that transition from print to online has already happened. So the volume, there's not real any gains from the volume growth from that transition helping REA and Domain. So the way they make money now is really through higher prices every year.
Well, but this is what I was alluding to before. Is it's not just higher prices; it's higher prices for more being delivered. So you're getting, if you look at their current offerings compared to what they were offering on their sites 10 years ago, it's vastly better. And they'll continue to take a larger piece of that, tens of thousands of dollars you get for selling, that's available for selling a property. They'll continue to get a larger slice of that. That's the argument.
Yeah, but I mean, I agree with that, but that's coming. I mean, they're not really adding anything more now, are they? Because the depth products are really just getting buyers to compete with one another to get their listings on the top of the menus of the search.
No, I think they are consistently. Look, people can go and see by looking at all their presentations, but they're constantly adding things, and they're constantly improving the offering. And
what more can they do to keep kind of improving? I mean, is it kind of predictive, or I guess they could do something like that. I don't know. Tell me, JC.
Well, I don't know. I didn't know 10 years ago, but I'm more open to the potential. They're the ones developing the products, and I think that they've got, I mean, look, this is the thing, isn't it? So it's hard to see the future like that, but they add a vast amount of value.
Yeah,
and the experience has been over the last 10 or 15 years that it's been improving. I suppose there's been that shift to mobile as well, so it's all now on mobile. And
I would I'd like to disagree with you about the value being I mean the products having more features and things. Because I sold a house about 3 years ago, and it both REA and Domain charged me about $3,500 a piece, and for me that was, as a percentage of the property value, it was quite low compared to especially what I was paying the agent as well. So if they had doubled that, I still would have been okay, fine. It as a percentage of the property value, it doesn't seem like very much, but I don't think they get away with that by putting in new features and things. I think that's just a psychological exercise to make you feel.
Well,
there's a lot
they do. There's a lot they do at the back end as well,
right?
For agents and stuff. And I have to say, I don't have direct
okay,
knowledge
right,
of
right.
that because I don't
Yeah,
pay them thousands a month to see
yeah,
all that. But there's more that they're doing in the back
yeah. That's true.
end.
That's true. My agent did tell
And
me that
so yeah,
REA was miles better in the back end to use than Domain.
yeah. And there's a lot of data that they have as well about
Hmm.
property
I
transactions and who's
reckon.
buying what, and so
Yeah.
there's a lot that goes on that we don't see just on the
Sure.
front of the
Okay.
website.
No, I accept that. Okay.
Well, I think as well, like just when you're looking for a house, you think about how much time and energy and, from the user's perspective, maybe there's lots of improvements in terms of how much time they can save you. And that's kind of the lines I was kind of thinking along is if they can kind of get to know you and what houses you might be interested in,
Mm,
then that might help you save some time or I
mm.
don't know. But I'm sure there's probably some other stuff that they can keep coming up with along the way, but I don't.
JC,
Well,
if you're a
I mean, that leads into the. Is this where you want to go onto the valuations, Gaurav? Because that's the question, isn't it? So
yeah,
now they're
yeah,
on. Earlier in the year, they were on. I think when they've previously peaked in January, February,
yeah.
they were on 30 odd times
Okay.
2022 earnings. Which is so 2022 earnings. You pick it because it's getting
Oh
close,
yeah.
getting close. Hopefully, this pandemic will be over roughly
Yep.
for them
Mm,
by then. Maybe not for some other companies, travel companies, but for these guys, I think it mostly should be. And now they're on multiples of 50 times earnings for 2022, which is quite extraordinary. And so it does beg the question. They've got to get a lot of growth, and so we should be talking about this growth because they've
Mm.
really got to get a lot of that for many years to justify that kind of price. And the market's betting on that. And look, I think it's right to a point, and we're publishing today an article which will um, it's a downgrade Domain to a sell. Whereas REA, we're just going to hold on for a moment longer if we can, raising its price guide from $140 to $150. But at these sorts of prices, at 50 times earnings, you're getting to a point where the risks are on the downside. You can't, they could justify those prices if they keep growing 10 or 20% a year for the next
mm,
10 or 20 years, but it's asking a lot of them.
mm.
And there has to come a point where you put the money. Well, we've still got ideas on our buy list, so there are still opportunities. But it's these growth stocks, and these aren't the only ones. Zero's another. I mean, there are other high quality growth stocks all across the market have got to quite extraordinary prices.
So, JC, in your opinion, I mean, uh, selling these great companies in the past, and there's no doubt REA, one of the best businesses on the bourse. Um, I mean, how do you
Yeah,
make
I
that
think I had.
judgment?
I think I covered it and put a sell on it in 2013, maybe
And
at
no doubt it looked
about
expensive, yeah,
$40 or something,
yeah.
and it was on a crazy PE in the high 20s, I think. And and
Those are,
I mean, those are the days. I mean, this is
yeah.
the thing. I mean, that was a mistake. I, as I've said, didn't really appreciate
Mm,
the growth of the depth product side of things. But there has to come a point where so much is baked in
mm,
at a multiple of 50 times, and that's earnings in 2 years' time as well. So yeah, growth stocks at the moment, high
mm.
quality growth stocks, the really high quality ones. Look, we hang on as best we can, but it's getting very hard to justify doing that.
But just to play devil's advocate, the counter of that is that REA, I think, I remember when I sold my place, REA, I thought REA sold my place, not the agent. The agent took a huge cut. He opened the door for everyone. But REA is what actually sold the property. And I think there ought to be a reversion of the fees being charged in this industry. You know, the agents probably ought to take the percentage cut that REA takes, and REA ought to take over time the percentage
Well,
cut
I
that
think
the agents take.
that'll happen. I think you still do need an agent because you need to be told how to dress your house up
Yes,
Well, and I think there's also just a human element as well. People
Yeah.
want to deal with a person when this comes to their biggest
I
asset.
completely agree. Yeah,
Um,
And the
but
human sort of schmoozing, sorry to use, but the human,
Schmooze.
but you can a good salesman
yeah,
can use a turn of phrase and can flatter your property on the in the inspections
three
while
percent.
people are there, where in a way that a website can't. So I think that there is but I agree that the balance of
Yeah.
fees needs to shift.
So if you think that, then there's potential. I mean, you could think about REA's fees potentially 10xing from here.
Oh, I think if they did that, then you'd pretty much have the whole. I don't think there'd be much left for agents, but they could go up considerably. And remember that property prices, grow over time. So
Mm.
that
But yeah, we
percent.
all know they never fall, right, JC?
Well, look, they haven't grown much the last couple of years, I don't think. But and who knows? I mean, that's another risk that faces these two companies
Geez, it's
because
a good thing Nathan's not on this podcast because talking
yeah,
to him
well,
about property, his head
but
explodes.
but but with the debt the nation's taken on and all that sort of thing. I mean, we could be if we had a serious recession, then these two stocks could be in trouble. I mean, the property market could, and
Yeah,
the
that's an interesting point.
equities.
Okay, so how?
I-
Okay, so
yeah.
they are quite. So yeah, okay, so they are quite highly correlated to the property market as well.
Hmm.
Okay, that would have been a really tough decision. I don't envy you having to sit there figuring out whether to.
Well, that's what I've been
hold.
doing for a couple of weeks. It's been tricky, yeah. It
Yeah,
sure has.
I'm
Yeah.
glad it was you, not me. Wow. All right, that's great, James. I look forward to having a look at that. And thanks for your time today.
No worries. It's been a pleasure.
Mickey, great work on Omni. You got us around, I think it was 3 goes. I'm pretty sure we had 3 goes at that, but you got us around
No, it was
eventually.
only two. You can't count.
I think he may have
No, there was
spoken
Oh, he's
two,
to.
been
but then we
rattling on
talked
about
about
it
it
for
Yeah,
on a
ages. Yeah,
podcast, and so yeah, that's all right.
there we go. And nice to hear you're out and about as well. So thanks for your time as well, Mickey.
Thanks.
For everyone else, thank you for listening.